Okay, hi everyone. This is going to be the lecture for chapter 6. We're going to be looking at some problems here. So it looks like, we got 1, 2, 3, 4, 5, 6 different problems. First few are a little bit more simple. As we move forward, the more complicated they will get. So let's look here at this first one. Right, it says Ida Company produces a handcrafted musical instrument. Looks like this item similar to a xylophone, and they sell it for $850 a pop. Selected data for the company's operations last year includes the following. Right, so they're giving us our units in the beginning, what we produced, what we sold, units in our ending, some variable costs, and then some fixed costs. Okay. First thing down here, right, it says assume that the company uses an absorption costing, right? Where does it say? Assume they use absorption costing. What would be the cost of one of those instruments if we were going to do that? Right, so let's put absorption costing. Now, with absorption costing, right, this is used traditionally in external reporting required by GAAP. When we're looking at the cost of a unit or the cost of our goods sold, right, COGS, we're going to include our direct materials, our direct labor, and then our manufacturing overhead, both our variable manufacturing overhead and our fixed manufacturing overhead. Right, so first thing we got to do is find our direct materials. Over here, it looks like that's $100. Okay, and we got to do our direct labor. Over here, that looks like $320. Okay, then we have our variable manufacturing overhead. They're telling us that's $40. Okay, and then our fixed manufacturing overhead, this one we have to do a little bit of math here, right? So we had total fixed manufacturing overhead of $60,000, but that's for, right, a bunch of different units, right? Specifically here we produced 250. They're asking us here the unit product cost for one unit. Right, so what we got to do here is take that 60,000, right, divided by the 250 we produced. On a per unit basis, that fixed manufacturing overhead's going to be $240. Right, so if we were to sum all of these guys here, right, we would have under absorption costing $700 per unit cost. All right, continuing. Right, let's look at B here. It says assume the company uses variable costing. Compute the unit product cost for one of the instruments. Right. Okay. So they want the same thing. So we're going to be looking here at variable costing. Make this guy blue. All right. Now with this, right, similar setup to absorption costing. However, right, we're going to be excluding the fixed manufacturing overhead, right? In other words, that's not a cost that we capitalize. Instead, we expense our fixed manufacturing overhead in the period under variable costing. So we'll have our direct materials, our direct labor, our variable manufacturing overhead, and that will help us figure out our per unit cost. Right, so these numbers we can snag right from up there, right? It's the same thing. The only difference between them is right? This guy right here, in absorption costing, right? All of our costs get absorbed into inventory. Under variable costing, right, this fixed manufacturing overhead, we don't consider that when we're looking at a cost of the unit, right? We don't capitalize that, put it on the balance sheet as part of inventory. Instead, what we do is we expense it in the period, right? So with this, one little quick note here, just so you're aware of it. When we have our selling and administrative expenses, right, regardless of whether you use absorption costing or variable costing, in other words, in both systems, your Sgna, selling general administrative, these are going to be period costs, expense them in the period. So in other words, they're never capitalized, never part of the product cost. Instead, they're a period cost, expense them in the period. All right, let's check out exercise 6.2 here, right? So first off, it says referring to data in exercise 6.1. All right, so we're going to be referring back to this tab over here to get some data. It looks like the absorption costing income statement. So what color did we make absorption? We made that yellow. Okay. So they produced an absorption costing income statement, and it looks like right there was $92.50 in net operating income. It's going to be like your traditional income statement, what you learned about before you were in managerial accounting, right? It's your sales minus your COGS, which gets you your gross margin. Back out that Sgna as a period expense. There we are, our net operating income. Right, and just to clarify, there is a difference between net income and net operating income. Sometimes because it's like the only expenses they're giving us, right? This could like say net income if there were no other expenses. When they say net operating income, they're really just looking at your operating income and your operating expenses. They're not looking at those other subsequent line items in the income statement. So I just say that, right, if I refer to it as net income or net operating income, I may use them interchangeably. Do be aware there is a difference there, but 9 times out of 10 it's going to be irrelevant because it's our only expenses, it's our only revenues they're giving us. In any event, right, first thing they're saying here is if we were using absorption costing, how much would the fixed manufacturing overhead, how much of that is going to be in the company's ending inventory, right? So they want how much of this guy right here is going to be in the company's ending inventory. All right, so for 1, that's what they're asking us to do here. Okay, so here's the idea with it. First thing we have to do is, remember it said refer to exercise 6.1. Looks like here we have 25 units in ending inventory, right? Now, in this case, right, we're using absorption costing, and we said on a per unit basis, we have fixed manufacturing overhead of $240. Okay, so what we're going to do here, right, is we're going to take this ending inventory, we're going to multiply it times this fixed manufacturing overhead because it's 25 units per unit, $240. Right, so we're going to do, in this case, 25 units times $240 per unit of fixed manufacturing overhead, right? That's what we capitalize. It's an inventoriable cost. We're looking at $6,000, right? In other words, when I pulled up the balance sheet, I saw the ending inventory, and I looked at that. I'd say, hey, $6,000 of that amount is going to be fixed manufacturing overhead. We're using absorption costing. All of the costs are being absorbed into it. All right, next guy here. saying, can you please prepare an income statement using variable costing? Explain the difference in net operating income between the two costing methods. Okay, we can do this. All right, so we got to do a variable costing income statement. So with this, right, we're going to be following that like contribution margin setup, right? It's going to be your sales minus your variable expenses, get you your contribution margin, back out your fixed expenses, get you your net operating income. All right, so let's start with our sales, right? We can put, where are we getting this from? Right here, 191, 250, right? That's going to be the same between them. Right, some of these numbers, like this is absorption costing. This one's variable costing. Some of the items are going to be the same, right? Your sales are your sales. How we organize this and separate it will be different. Sometimes it's just moving items around. Other times it's like literally excluding stuff or including it, right? Like a difference would be fixed manufacturing overhead. In any event, right, we're doing a variable costing income statement here, and it's going to follow the contribution margin format. We got our sales. Now we got to back out our variable expenses. Right, so it's just going to be a line item there, right? So we have our variable cost of goods sold. Now in this case, right, we're going to go back here. We sold 225 units, okay? And we're using variable costing. We said the cost per unit there is $460, okay? So here, it's gonna be the 225 units we sold times the $460 cost per unit. We're looking at $1035. Likewise, we're going to have variable selling and administrative expenses. Sometimes it's called Sgna, selling general administrative. In this case, right, if we refer back to 6.1 here, our variable costs, we have variable selling and administrative, right, of $20. Okay? And in this case, what we're going to do is, again, we sold 225 on a per unit basis. It was $20. All right, so 225 we sold times the $20 variable SGA per unit. We're looking at $4,500. All right, that can help us get our contribution margin. Right, we'll do our sales minus these two guys. We're looking at $83,250. All right, next thing we got to do is back out our fixed expenses. All right, so we have first off here, fixed manufacturing overhead. Right, this is going to be $60,000 across the board. Can snag that. Likewise, right, I believe we have some fixed selling and administrative, $20,000. Right, so we're going to use that number. And again, why did we use 20 here times 250 or 225? Versus here we're using the full 20. Right, well, this is on a per unit basis and we had to multiply it over. This is giving us the total fixed cost. So it's like unitary versus total. So we can throw that in, right, the 20,000. Accordingly, our net operating income, right, we can call it like net op income. Maybe that's like cool. It's like espionage or like Splinter Cell or something, right? This is like an op we're doing. Got to make accounting a little bit fun, right? This isn't the most inherently interesting items. So we'll take our contribution margin minus these guys. Right, we're looking at a net operating income here of $32.50. Right, so at the end of the day, what's going on? Right, we got an absorption costing income statement where we're at $92.50. We have a variable costing income statement where net operating income is $32.50. So they want to know, what's the difference between them, right? Why are these shaking out to be different from one another? Well, the idea here is that the difference in the net operating income between our variable and absorption costing, how we can explain this, it really deals with the deferral of fixed manufacturing overhead, right? In other words, this deferral, which is going to happen under the absorption costing method, right? We kind of punt on it until we sell it. In other words, we have fixed manufacturing overhead. We don't expense it whenever we incur it. We punt, right? Defer it, kick the can until later on. We put it as part of inventory, and then later, when we sell the inventory, we take the expense. Right, so it'll be on our balance sheet. It's going to puff up that inventory level on the balance sheet. The reason there's a difference between these two net operating income, we do that over here for absorption income statement. Over here, we're going to expense out that fixed manufacturing overhead right when it happens. Right, we don't kick the can on it. We take it now. So that's really the difference between those. And we mentioned this in the PowerPoint, right? Why do they even have these differences? Well, this guy right here is traditionally going to be GAAP for, right, like external reporting, whereas this variable costing, this is more for internal reporting. Right, so we're in a managerial accounting class. It makes sense that we would look at this. Just different strategy, different technique. It doesn't mean one is necessarily better than another. It all depends on what you're looking at, right? So if you're like a manager internal to the business, it might be better to see a variable costing income statement. It would help you in decision making. It's more suitable and functional to let you see how the business is running. If you were an external investor, right, you were looking to, buy some stock, you'd probably be more interested in an absorption costing income statement. All right, 6.3 here. Let's look at this guy. All right, so they're giving us some information here. We have a lighting company, and it looks like they are using variable costing for their reports, and they have the following information, right? So we are making variable costing blue. Okay. One of the things here, right, it says the company's fixed manufacturing overhead per unit was $560 for all 3 years. All right, first guy, it says, can you please calculate each year's absorption costing net operating income? Present your form in a reconciliation report. All right, so here's the deal with it, right? They're giving us this on the variable costing level. We have to reconcile from the blue to the yellow, right? How do we get there? Said the big difference here between these is going to be that fixed manufacturing overhead. All right, so first thing that we're going to want to do here, right, to help us get us where we need to be, let's build out a little chart here. We need to first look, how much did our inventory change each year? Right, so we'll have beginning inventory, we'll have ending inventory, and then we'll have the change. Right, so it looks like we went from 200 to 170. We went from 170 to 180. We went from 180 to 220. Right, so it looks like, just do that here. Right, in this case, we increased by $40 or 40 units. We went up by 10. We went down by 30. Inventory increased, inventory increased, inventory decreased. Okay. All right, next thing we got to do, right? We have to figure out how much of our fixed manufacturing overhead is in our ending inventory, right? So fixed manufacturing overhead in our ending inventory. And we'll just make this column, let's do this right, year 1, year 2, year 3, center that, and that's going to be like the column all the way down, right? So you're going to have to watch a little bit carefully here for this, right? So we're looking at fixed manufacturing overhead in our ending inventory. First off, we said, right, that it's $560 per unit. So we'll take the $560 per unit. Looks like in year 1, right, our inventory is, what, ending inventory is 170. So we're looking at 95.2. In year 2, right, it's $560 per unit times 180. And for year 3, right, we just copy that formula over. Next, right, we gotta look at the fixed manufacturing overhead in our beginning inventory. Right, so maybe this, I'll just make blue, right, so we're consistent with where we're getting, you can see where these numbers are coming from. So again, all we're gonna do is 560 fixed manufacturing overhead per unit times 200, okay? 1112, copy that formula over. Now, in this way, right, we're going to figure out the difference between them, right? So let's just do that minus that, and then we're going to copy it over. Right, 100 minus 95 is 5, 123 minus that is 22, 95 minus 12 is negative 16,800. So here's the idea. What this is going to represent here, right? This is going to be the fixed manufacturing overhead. In this case, if it's positive, which was deferred in our in our inventory, or if it was negative, was released from inventory. So let me kind of break that out here. Right, so one of the things that we kind of have to be aware of before we analyze this, if you remember from the lecture, right, one of the things we have to compare is our units produced with our units sold, right? If they equal each other, if our production is greater than we sold, that's too big of a P there, our production is less than we sold. Right, and the idea with this is this will affect our inventory. Okay, so if we produced what we sold, we're going to have no change in our inventory. Right? If we made more than we sold, our inventory is going to increase. If we made less, or I'm sorry, yeah, if what we made is less than what we sold, our inventory went down. Right? So like this one, for example, maybe you made 100 robots, right? But you only sold 70 of them. And the net of that is, right, you have 30 additional robots that you added to your inventory. Okay? Now, the next little column here with this is, right, we're going to have our absorption costing. It's going to be equal to our variable costing. Right, so the idea here is your net operating income. Your inventory. In this guy, right, your absorption costing, net operating income is going to be greater than your variable costing, net operating income. And in this one, right, your absorption costing is going to be less than. Right, so what we have to do here, right, is, you know, in light of this chart, what we're figuring out is, right, our inventory went up, it went down. The difference between that is caused by this fixed manufacturing overhead, right? So if we're going to reconcile here, right, go from our variable costing to our, and it moved these guys. Where was this at? Fixed manufacturing overhead, $60. No, this is where it was at. And where was this at? Man, why'd they gotta move this? Alright, not a big deal. So let me reset here. That like really threw me off that they moved the highlighter there. So in any event, right, we're going from variable costing to absorption costing. We're trying to reconcile this, right? We said the difference between them deals with fixed manufacturing overhead, and then we built out this little chart. Okay, so what we're going to try to then do is we're going to try to go, our next line item here for 3 is going to be our variable costing net operating income, okay? This we can snag right from over here. It looks like 1,080, 400, 32, 400, 103, 400, okay, 996, 400, that's where we're at. Next we gotta do is, we're going to add, if it's a positive up here, or deduct, right, if it's a negative up here, our fixed manufacturing overhead that was deferred or released from our inventory under absorption costing. Let me kind of wrap this here. All right, we can just link this. Right to up here. This is going to get us our absorption costing net operating income. Let me do this. It's going to be this 108. That's that guy. Be this. this guy, that's going to be 108,800, and let me put the highlighter down here. Right, so here's the deal with this. Right, we started with our variable costing income statement. Right, we had net operating income of these three guys. We said the fixed manufacturing overhead was $560 per unit. We then had to get here, right? They said, can you please figure out your absorption costing income statement? So what we did is we looked at our change in inventory during the period. Did it go down, right? Was our production less than our sales? In other words, was our absorption costing income less than our variable costing income? Okay. Next, in this case, we looked at year 2, year 3. But first thing is we figured out like a per unit change here in inventory level. Did it go down? Did it go up? Then we quantified our fixed manufacturing overhead in our ending and beginning inventory times that amount. That told us how much we deferred or we released under the system. Took our variable costing operating income right here, adjusted for this guy, what we calculated up above, and we got to our absorption costing net operating income. So this is like kind of the whole idea right here. You start from here, you make an adjustment, it gets you to your absorption. Okay? Right, and this is again just showing you, right? If you're at 108 and it went down, the inventory, the idea with this is our absorption costing net income down here, the 106, is going to be smaller than the 108 up there. In other words, the variable costing income is going to be overstated, right? Because we're building in that additional fixed manufacturing overhead on the balance sheet. We're not expensing it. We need to expense it in our absorption costing. So because we have that additional amount of the expense, it's going to make our income under the absorption costing lower. And the reverse is going to be true for these two guys over here. All right, 2 here, it says in year 4, the company used variable costing. Net operating income was $984,400. And absorption costing net operating income was $1,012,000. So let me just, right, so they're saying in year 4 we had that for variable costing, and then in our absorption costing we had the $1 million there. First off, A, they want to know, did inventory increase or decrease during the year? And B, how much of fixed manufacturing overhead costs was deferred or released from inventory during year 4? Right, so if we're looking at this for 2A and 2B, the answer here is going to be this, right? Because absorption costing net operating income was greater than variable costing income in year 4, right? In other words, because in year 4 here, right, our absorption costing net operating income is greater than our variable costing net income. If we go over to our little chart, right, this is going to mean over here that our inventory has increased, right? And the idea with that, because it's increased, right, our fixed manufacturing overhead is going to be deferred in the inventories. Now the amount of this deferral, right, for the second part, what we're going to have here is going to be the difference between these two amounts, right? If we took the 988 and the 1002, right, if we figure out the difference between those, it's going to be $28,000. Okay? All right, let's go to exercise 6.4 here. Right, they're giving us some information. We have a lawn care company. They sell 2 products. Right, it looks like Weed Ban is one of their products, and then they sell Green Grow. Right, revenue and cost information related to the following. Okay, so it looks like they're giving us some segment information. Right, each of these different lines is going to be a segment of the business, or like an operating line. And it says last year the company produced and sold 15,000 units of the Weed Ban. Oh, sorry, gotta make that yellow. And it looks like 28,000 of Green Grow. Its annual common fixed expenses are 33,000. Right, so common fixed expenses of 33,000. All right, what they want us to do here is please prepare a contribution format income statement segmented by product lines. All right, so we're going to have, in this case, right, kind of like a total company column. Right, we're looking at the whole lawn care company in itself. We're going to look at the Weed Ban and then the Green Grow. Okay, so Green Grow, I think we made this is company wide. All right, so first thing we got to do here is our sales. Okay, so we kind of have to quantify this a little bit, right? We got some from the Weed Grow and the Green Grow. So if we go over here, looks like for the Weed Grow we sold 15,000, right? So it's going to equal 15,000. And if we look at the facts for it, they sold it for $6 a pop. Green Grow, the blue guy, it looks like they sold 28,000, and that was for what, $7.50 a pop. Okay. Add these two together, we're at 300,000. Right, so 300,000 of total sales. Weed Ban was the 90,000. Green Grow was the 210. All right. Next thing, they want a contribution format income statement. We got to back out those variable expenses. Right. So with this, right. So this was our sales right here. We'll do a little item here for our variable expenses. Okay, so we got let's start with the Weed Ban. Right, so this is going to be the 15,000 units they sold. Right, they're telling us there, times the 240 variable expenses. We're looking at 36,000. For Green Grow, right, they got 28,000 times 525, right? 28,000 times 525. 147. All right, we total those together, we're looking at 183. It's going to get us our contribution margin. Okay. Next thing we got to back out here are our traceable fixed expenses. And if we look at this, right, looks like green grow, we got 21,000. Right from over here. Looks like we got 45,000 for the weed ban. Add those two together, we're looking at 66. Alright, so then if we take our contribution margin minus our traceable fixed expenses, we're going to have our product line segment margin. Right, we take this contribution margin minus our traceable fixed expenses. Carry that across. One of the items here, right, that we got to be aware of, at least from a total company standpoint, right, we're going to have our common fixed expenses that are not traceable to products. That's a big guy there. Right, and the idea with that is that's going to be the 33,000. Right, so we don't have that. We can't really trace it to the weed ban or the green grow, exactly, but we can, from a company-wide item, look at it. So whenever we look at our net operating income, for the company as a whole, we're going to be at 18,000. Right, so this one wasn't too bad. All we did was looked at it from a company as a whole, looked at it from a segment by segment. We're able to, for each segment, find their product line segment margin or their segment margin, specifically to that area. In that, though, right, because we had these common fixed expenses that we couldn't trace to any one segment, we got to back that out from the grand, the mega view, right, the total company view. It's going to get us our net operating income here of the 51 minus 33 equals 18. All right, let's look here at exercise 6.5. They're giving us some information. We have a company. They segmented into regions. Looks like north and south. They're giving us a contribution formatted segmented income statement. They want to know a couple different things here. Right, they want to know company-wide break-even point in sales dollars, break-even point for the north, break-even point for the south. Right, so we're looking at kind of like, the total from the north and from the south. Okay? So the idea is if we're going to start from company-wide and we're looking at break-even point in dollar sales, the equation for this, maybe I'll just write it. Right, so I'm going to put dollar sales for company break even. Right, that's going to equal our traceable fixed over here. Just going to write this smaller. This equals our traceable fixed expenses plus our common fixed expenses all over the overall contribution margin ratio, right? So I'll read it again if you're having trouble seeing that. Sorry, my penmanship's not the greatest when I'm writing with the mouse. So our dollar sales for the company-wide to break even, the equation is going to equal our traceable fixed expenses plus our common fixed expenses divided by the overall contribution margin ratio, right? So what we would do here, right, our numerator is going to equal our traceable fixed expenses are 120, right? 120,000. We're going to add to this our common fixed expenses over here of 50,000. That's our numerator, 170. And then our denominator here, right, if we were to try to find that contribution margin ratio, right, that's going to equal, in this case, right, our contribution margin of 240,000 divided by, in this case, our sales of 600,000. Take a minute to look at that. We're looking at 0.40. All right, so in other words, when we do our numerator, right, the 170, these guys, divided by our denominator, the overall contribution margin ratio, we're looking at 425,000. In other words, for the company-wide, total company to break even, right, it has to sell, in that case, $425,000. Okay, that's at a company-wide level. Let's look at it from the north region, right? We're going to just focus on the north right here. So in this case, right, because we're looking at it from just a segment, right, the break even in dollars here right, the equation for this is going to be our segment traceable fixed expenses divided by our segment contribution margin ratio. So we're just looking at it from a segment level. All right, so here's the deal, right? If we were to populate this one, we're looking at the north, right? So for the numerator, if we look over here, it looks like $60,000 are our traceable fixed expenses for the north. Our denominator, it's going to be a contribution margin of 120,000 divided by 400,000 of sales. Right, we're looking at 30%. So the idea for this is, right, if we take our numerator, our segment, north only, traceable fixed expenses, divided by our denominator, our segment contribution ratio, our break even in sales dollars for the north is going to be 200,000. Right? In other words, based on these facts and circumstances, if the north wants to break even, it's got to sell 200,000. We can do it for the south as well. It's going to be the same equation. Right up here, if we kind of plug these numbers in, right, for the, if we look at the north here, so we did the north, now we're doing the south. In this case, right, we're going to again have $60,000 traceable expenses. Our contribution margin ratio is going to be 120,000 divided by 200,000, right? The 120 divided by the 200, we're looking at 0.6. All right, so if we take our numerator divided by our denominator, we're at 100,000. Okay? All right, last problem here. We'll kind of see where we get. We may do all of it. We may cut it a little bit short. Let me take a sip of my coffee here real quick. All right, so let's break this out one at a time here. We got to do what, 1, 2, missing 4. Okay, there's 3. That's my magic trick, right? I made 3 appear disappear. I wasn't seeing it. So let's do 1 first, right? Before we get too bogged down here. First one, they know, right? We gotta do here our break-even point in unit sales, right? So we were kind of just looking at this before in a modified version. First thing we have to do here, right, for our break-even in unit sales, right? So break-even, in this case, in units, it's going to equal our fixed expenses divided by our unit contribution. Okay, and they want this for the company here. All right, so first thing we got to figure out is our unit contribution margin. Okay, we'll start with this guy right here. So our selling price per unit, based on these facts, it looks like it's going to be, in this case, $58 per unit, right? Selling price, $58 per unit. Okay. In this way, we then got to back out our variable costs per unit. So what this is going to equal, right, is going to be our direct materials, the $20, right, the $12 for the direct labor, plus the $4 for the variable manufacturing overhead, plus the $2 for the variable Sgna. In other words, all of these guys right here are variable expenses. All right, we're going to be looking at $38 there. This is going to give us our contribution margin per unit, right? The 58 minus the 38. We're looking at $20, right? So that's the denominator, right here. So let me just make 20 there. Next thing we got to do here is get our fixed expenses, right? So in this case, right, it's going to be the 960 plus the 240. Right, that's going to be, in that case, $1.2 million. Just make that blue. All right, so this is like the magic moment, right? If we take our numerator, our fixed expenses, divided by our contribution margin per unit, the $20, we're looking at 60,000 units. Right? In other words, based on these facts and circumstances, if we want to break even, we need to sell 60,000 units. Okay? All right, let's look at 2 here. They're saying, assume the company uses variable costing. All right, we did that with blue. Okay? So just to kind of keep it the same here. And then in this one, they're going to want absorption costing, it looks like. All right, so what they want us to do here is, under a variable costing scheme, compute the unit product cost for 1, 2, and 3, prepare an income statement for 1, 2, and 3. All right, so for 2 here, we're using variable costing, right? And we're going to have year 1, year 2, year 3. All right, and they want, what's the first one here? The unit cost, right? So we kind of looked at this already, right? So it's going to be our direct materials, our direct labor, and then our variable manufacturing overhead, right? We're not going to include our fixed manufacturing overhead because this is variable costing, right? So this will give us our variable cost, variable costing unit cost. Right, so it's going to be $20 from over there, 12, and 4. Right, just pluck those out. If we were to add them together, right, we're looking at $36. Now it's going to be the same across the board there, right? They're not indicating the facts are going to change. And again, the selling and administrative expenses, these aren't product costs, right? We're not going to look at them right now, at least, whenever we're looking at the unit or the product cost. Selling and administrative is a period cost. All right, so we'll do an income statement here for this guy under variable costing. So we're going to have our sales. Right, now the idea with this is, let's, it looks like we sell it for $58 a unit, okay? So 58, and it's saying let's see, during its first year they produced 60 and they sold 60, right? So we got 58 times 60,000, right? From over here, they sold in year 1. We're looking at 348 there. In year 2, we sold it for $58. In the second year, it sold 50,000. And then in year 3, right, it's $58 a unit, and it looks like we sold 65,000. Okay? And a 3770. Because it's variable costing, we got to back out our variable expenses. Right, we have our variable costs of goods sold, and we have our variable Sgna. Right, so for this one, I'm going to put $58. Right, that's what we use there. The variable cost of goods sold. Let's see if we can figure this out here real quick. Right, so we looked at this, right, it's 20, the 12, the 4. In other words, this right here, the number we're going to be using is the $36 from over here. And our variable Sgna was $2. Right, so if we take the 36 in year 1, looks like in year 1 we sold 60,000 units. Right, we're looking at 216. In year 2, right, we have the 36. We sold, let's see here, 50,000 units. We're looking at 180. In year 3, it was $36 from up above, and we sold 65,000 units. Okay? Now, we got to do our variable Sgna. Right, so this is going to be the $2 per unit in this case. And if we look here, right, in year 1 we sold 60,000. In year 2 we sold, let's see here, 50,000. And in year 3, right, the $2, we sold 65,000. Okay, so with that, we can get our contribution margin. It's going to be our sales minus our variable expenses. Carry that across the board there. Then we got to back out our fixed expenses, right? We got fixed manufacturing overhead. We got fixed Sgna. If we go over, right, they're giving us these numbers over here. Looks like it's going to be 960,000 each year and 240,000. Accordingly, right, if we take our contribution margin minus our fixed expenses, right, we're gonna break even in year 1. We're gonna lose 200,000 in year 2. We're gonna make 100,000 in year 3. Okay. Now, if we look at the next thing they're asking us here, so we've done 2 now. Computed the per unit cost. Right, that was this guy. And then we did an income statement. Right, that was that guy. Now we're going to move on to 3 here. For 3, it says, assume that they use the absorption costing. Right, so for 3, we're going to have absorption costing. All right, we can have years 1, 2, and 3. Now, I'm going to move this down. Again, let's see something here. Nope. We'll just reference up to it, not a big deal. So under the absorption costing income statement, we're going to start with our sales. Right, and again, these are the same under both. Right, so we can just copy those down from up here. Right, the sales come down. Then we're going to back out our costs of goods sold. Okay. Okay, so to get this, right, our cost of goods sold, we're going to have to add on to this amount here. So let me explain to you real quick what's going on. Right, we're now doing absorption costing, right? We got to figure out the per unit cost built in. They're asking us to do it again, not a big deal. It's the same as above, right? But we got to add into there our fixed manufacturing overhead. So that amount, right, it's a flat 960. Right, we grab that from up here, and you have to divide that by the number of units we produced in each year. Right, so in year 1, it was 60,000. In year 2, right, we have 960,000 divided by, let's see how many we produced, 75,000. Okay. And then in year 3, right, we had 960,000. We produced, let's see here, 30 or 40,000. We produced, okay? Now we can add all of these together. Right, the sum of those guys, the sum of these guys. Right, let me just double check this here, right? 960 and is in year 2 produced 75,000. Okay, so now what we got to do, right? We got to take the 52 unit cost in year 1 times the 60,000 we sold. Okay, we're looking at 312. We got to take the 48.4 in year 2 per unit cost under absorption times the 50,000 we sold. And we gotta take the 60 in year 3 times, let's see here, how many we sold? 65,000. Okay. Right, so with that, we're gonna have our sales minus our cost of goods sold. This is gonna get us our gross margin. Right, that guy minus that guy. Carry it across. Right, so it looks like we're positive, positive, negative here. Now, next thing we gotta do is back out our Sgna expenses, right? So it's going to be, in this case, a combination of, so there's a little bit of math here, so let me explain it to you, right? We have the $2 per unit, right? Plus we have the fixed amount. They don't break it out on here between fixed and variable on the absorption costing. They lump it in all together, right? So this is going to be a little bit of math. In year 1, right, it's a $2 variable Sgna expense times, let's see here, let's go up real quick. So we sold 60,000, so we have 60,000 in year 1, right? So that's the variable portion plus, in this case, the fixed portion. And I gotta do the equal sign. All right, let's do it for year 2. Right, it's the $2. Go up real quick. Year 2. Let me see real quick here, sorry. 50,000 plus the fixed portion of 240,000. And then in year 3, right, we got to do the variable of the $2 per unit. We sold in year 3 65,000 units, right? So 2 times 65,000 plus the fixed component of 240,000. Accordingly, right, when we take our gross margin minus our Sgna, our net operating income or loss is going to be 0, 120,000, and 220,000 there. All right, we're going to skip 4 here. You know, we don't need to do that. We're running over on time here. So the idea with this is just a rerun of what we've done. It's a little bit more complex here with it. But at the end of the day, right, what's this chapter all about? We're looking at absorption costing, which is used for external reporting. In that, right, they're going to include in their inventoriable, they're going to capitalize, put on their balance sheet, their direct material, their direct labor, and then their fixed and variable manufacturing overhead. In distinction, right, we have variable costing, where what we do in that case is we break out our selling. We have our sales minus our variable costs, gives us our contribution margin. We back out then our fixed expenses. That gets us to our net operating income. And in that case, right, instead of capitalizing our fixed manufacturing overhead, we're going to expense it in the period it incurs. So with that, I'm going to end the lecture here.